Welcome to Retiring Today. In this episode, we're talking about taxes and how a multi-year tax planning strategy can keep more spendable money in your pocket. I'm here with Loren Merkle and Chawn Honkomp. Both of these guys are certified financial planners, and they're both certified financial fiduciaries. And Chawn is also a CPA. Chawn, you don't file taxes anymore, but each year when April comes around, you probably remember the process very fondly and how people are kind of getting ready for April and gearing up. And for some people, they get kind of nervous too.
Yeah, there is a lot to think about when it gets to that tax time of year. Yes, I don't file taxes anymore. I spent about 5 years in public accounting, so that part of my career is behind me. But now, as part of what we do here at Merkle Retirement Planning, talking about taxes and thinking about taxes, it continues to be something we talk about with our families.
Yeah, so a lot of people know, of course, April 15th, the big tax deadline. But Loren, when you approach taxes as you help people move to and through retirement, it's really a two-pronged approach to helping people.
Yeah, it's really a multi-level approach to helping people be prepared for filing taxes. We've all heard this phrase, prior preparation prevents poor performance, and that is very true when it comes to filing taxes and increasing your spendable income and decreasing what you owe from a tax standpoint, not only for you while you're alive, but also potentially for your beneficiaries. So one of those steps that we need to look at prior to filing the taxes is how much have you paid in taxes throughout the course of the year. So if you're working, you have a withholding from your paycheck. So how much are you withholding from your paycheck versus your total tax bill at the end of the year? That's going to help prepare for, do you have to write a big check at the end of the year, or are you going to get a return? And then you can start putting some strategies into place for either how to prepare to write that big check or what to do with the tax return that you receive. If you're retired, now there's this thing called estimated taxes that you might pay on a quarterly basis. Again, at the end of the year when you file your taxes, or in the springtime when you file your taxes, you're going to have to true up. Did you estimate too much from a payment standpoint? Did you not estimate enough? And then how are you going to go about making up for that tax bill that ultimately you owe?
And Loren, in retirement, is that estimated taxes, is that something kind of new for people, or have they maybe, if they've worked with a CPA prior to retirement, have they already been doing that?
It's new for retirees, for most retirees, because when you're working, you have your taxes withheld. Most people, as long as it's W-2 wage. But for retirees, it's a whole new atmosphere, just like a lot of the decisions that retirees have to make, whether it's Social Security or advanced tax planning strategies. A lot of these things is a complete new universe for retirees. So it's something that they have to gain information on, either from their retirement planner or their CPA, or maybe from both of them.
And one great way to look at it is you think about it, we are a pay-as-you-go society. So we're used to paying, just like you said, Loren, along with the paychecks. When retirement or income sources change, that pay-as-you-go process may look a little different in retirement.
And when it comes to paying taxes, there are some misconceptions out there, Loren. We recently heard someone say, I don't have to pay taxes after I hit age 85, right?
That would be really nice.
Be great.
It's the thing, is we hear a lot of different misconceptions. That is one that is circulating around. It would be nice to reach this magical age and then not have to pay taxes anymore. Unfortunately, that is not reality. What is reality is that if you engage in the tax planning, create tax diversification, is in retirement, you have a lot more control over the level of tax that you pay. When you're in the working years, you have very little control because you have your W-2 wages, maybe some 1099 wages, and you're going to be taxed at ordinary income. In retirement, you have Social Security, which is tax favored. You might have some Roth money, which is tax free. You have pre-tax IRAs, which is ordinary income, but you can control where the income is going to come from these different levers if you have that plan in place. So maybe you don't have to pay taxes if you incorporate the plan and it works for you that way, but most people do pay some type of federal tax in retirement.
And we know one of the constants that we've always heard, right? Taxes is one of those constants that you've heard about throughout your life. Loren already mentioned it. Social Security itself is taxable. Just having a conversation recently with a very professional, experienced individual, they even had opened part of that conversation and said, well, we don't have to pay taxes on Social Security at all, right? Another misconception that's out there. So there are these challenges, uncertainties that are part of the tax planning that you want to put in place as you continue your journey to and through retirement.
And part of these misconceptions are fueled by where people receive information and tidbits of information. So as a part of that Social Security conversation, maybe somebody was talking about in the state of Iowa, you don't have to pay tax on Social Security, which is true, but then somebody else heard, or somebody else took it as if they don't have to pay federal tax. Or there are some people who don't have to pay any federal or state tax on Social Security based on income. So maybe that person was talking to these people, they don't, right? So all of these rumors go around, and that's where facts really matter when it comes to building your retirement plan.
Yeah, I think sometimes it's easy to just kind of lump state and federal taxes together, but there are clearly a lot of different rules in each state about those. When it comes to tax planning, one of the things that I think kind of sets Merkle retirement planning apart maybe from some of the other people that are out there doing some of this stuff is that tax planning is part of the comprehensive plan. We work it into what we call the Merkle retirement method.
Yeah, what we've always been taught is investments are our retirement plan. The IRAs, the 401k plans, the mutual funds, the stocks, the bonds, that's our retirement plan. But in reality, that's just one component of the retirement plan. And that's why we built the Merkle retirement method as a process to customize individuals' retirement plan. Tax planning is one big principle of the Merkle retirement method because taxes are the #1 wealth eroding factor in retirement. So if you can mitigate the impact of taxes on your retirement plan, then you can increase your spendable income by decreasing your tax bill. Thank you for watching this clip of Retiring Today, and don't forget to subscribe. If you have questions about your retirement plan, take advantage of the complimentary 15-minute retirement checkup phone call.